My guest today is Bob Carlson. He's the editor of the Retirement Watch newsletter. And today we're talking about IRAs and what to do with all of the money. Now, required minimum distributions hit when you're what, 70 and a half?
70 and a half.
Yeah, and I know that used to be with a lot of financial planners, they said, oh, you need to withdraw like 4% per year to maintain your standard of living. That's not really quite the case, is it?
It's not the case, and it's not the way the IRS sets up the distribution table. They actually increase the percentage you have to distribute each year because they want that drawn down by the end of your life expectancy. So you have less control over your IRA and your distributions once you reach age 70 and a half. And many people don't realize that. They're kind of surprised both by the fact they have to withdraw from the IRA, and then when they get into the details, they don't realize that it increases as you get older. And many people, when they get into their late 70s, early 80s, they're being forced to take out far more money than they need or want to. It's causing income tax problems, and it's draining what they intended to leave for their heirs.
So is there any solution for that? Any pre-planning they can do?
There are a lot of things people can do. It's important to try to plan early, but you can still do things after age 70 and a half. But the main thing is to draw it down early. You can either just take it out, put it in a taxable account. You can also roll over to a Roth IRA, pay the taxes now, leave that Roth IRA to your heirs, so they're going to have tax-free lifetime income from that. If you have a significant IRA, then you can get into some creative strategies. For example, you can take the money out, pay the taxes, and then buy an insurance policy with a lump sum premium, and you'll be leaving your heirs with actually significantly more money that way than if you either left it in the IRA or just put it in a taxable account. So there are several things you can do as long as you start planning early enough before you get into your late 70s or your 80s.
How early is early enough?
Well, the earlier the better. If people aren't yet 70 and a half, I've often recommended that they just draw down that traditional IRA quickly, get it out of there. So the thing many people don't realize is your traditional IRA, it's ordinary income to you.
Right.
You lose the tax advantages of long-term capital gains and qualified dividends. So if you pay your taxes now, so you get away from that future ordinary income, your future income, you can have some control of it. It can be long-term capital gains, it can be qualified dividends, you can deduct your losses against that income.
Okay.
Things like that are not available through the IRA.
So it would behoove all of us to get a good financial planner.
Very much.
Yes, thank you, Bob.
Thank you.
And thanks for joining us at the MoneyShow.com video network.